What's going on, everyone? Shalon Winter here. All right, this is going to be another video. This one is going to be ICT beginner terminology. And because I post a lot of videos showing my framework, a lot of my trade recaps, things like that, I get a lot of people asking me, well, what's this? What's that? And because I just kind of like rattle things off sometimes, right? Oh, fair value gap or order block or this or that. And a lot of people that don't know yet, they ask me, what is this? What is that? So what I'm going to do on this video is we're going to jump to my screen here in just a second. And basically all of the terminology that I use, and without getting very deep, right? I just want to give you a basic understanding of what it is and what it looks like. So without further ado, let's hop right over to my screen. All right, now that we're over here on my screen, we're going to just jump right in here, okay? The first one is going to be a fair value gap, all right? A lot of people know what a fair value gap is. Most people have heard that as probably the most common ICT term there is right now. Fair value gap, fair value gap, fair value gap. Well, a fair value gap takes 3 candles to form. You have to have 3 candles. And let's go into here and show you what exactly that looks like, okay? So a fair value gap is going to look like this. In this example, right here, we have there's fair value gaps all over the place, right? So just because you see things don't mean that you can just use them all the time. That's why my framework video is so important, because it shows how to use some of this stuff, okay? But if you look here, right, we know a candle has a body, right? You have a body, and then you got a wick usually down, a wick usually up, right? That's typically how a candle is going to look. So a fair value gap takes 3 candles. So if we look here, let's zoom in on this real quick. Hold on one second. Let's get right up in here and zoom in. A fair value gap has to have 3 candles for this formation, okay? So we're going to look at 1, 2, 3 candles, okay? So 1, 2, 3. When you have a series of 3 candles, and we look just at these 3, a fair value gap is going to be when you have a gap between the highest, if the candles are going up, right? So in this example, the candles are going up. My purple candles are up bars. Okay. So if you have a gap between the highest point of bar 1, okay, which here's the wick here. There's the highest point right there. And then the lowest point of bar 3. Okay. So if this is bar 3, here's the lowest point right here, right? So between this lowest point and this highest point, other than the body right here, is there anything in between it? No. So this highest point of this candle and this lowest point right here, there's nothing. They never went between each other, right? So let's show you another example of what it doesn't look like. So let's look at these 3 candles, and it doesn't matter if they're up or down. Okay, 1, 2, 3. You see how the high point of this candle goes all the way up here, right? And then you can see the lowest point of this candle is down here. So this lowest one is actually lower than this one, right? So there's no gap between. Does that make sense? I hope that makes sense. So if you look between these 3 right here, 1, 2, 3. The highest point is higher than the lowest point here, because this is going up still. So there's 0 gap there, okay? Going back to these 3, right here, 1, 2, 3. The highest point right here is lower and not above the lowest point of this one. So if you draw this out, it's not very straight. There's a gap between them, right? So let me show you with the tool on the chart right here, this trading view. So if I mark out a line, okay, from the highest point of this one, mark out a line from the lowest point of this one, You see that? There's a gap between them. And that's what you call a fair value gap right there. Okay? So, very simple. Fair value gap. Now, the next one is going to be the inversion fair value gap. IFVG. Just call it inversion for short. Okay, same thing. It takes 3 candles, but this time price has to close through it. What do I mean by that? All right, here's what I mean. Same thing. We have a fair value gap here, right? So the way this should work is the bars are going up, correct? So if the bars are going up, this is a bullish fair value gap. So typically what should happen if this is a fair value gap that's going to be used, this would act as a support. Okay? So if price did make its way back down here, it should probably hit it and then continue up. Okay? So that's typically what a fair value gap does. However, an inversion means price came down, and instead of stopping here and going up, it actually closed. The bar closed through it. Now, this is called an inversion if the bar came down here and closed through it. And what should happen at that point is it come back here and then continue down. That would be an inversion. So let's find a quick example of an inversion. All right, let's get rid of that, get rid of that. It shouldn't be too hard to find one because they do happen. And like I said, it doesn't mean that you always use everything just because they happen, okay? So here we go. Here's an inversion right here. All right, so here, it's basically you have it's a fair value gap first, right? So if you look, we have a fair value gap right here first between these two. Right there and right there. Okay, does that make sense? Because price is going up, you have the lowest point right here. The highest point of bar 1 here. And then the lowest point right here of bar number 3. Okay, that's bar number 2. So there's your gap. Now, price came down and it closed because a down close candle, the close is the low of the bar. So it closed below this fair value gap. And when that happens, that turns this into an inversion. Inversion fair value gap. Okay? Then it comes back up and then trades down. Not saying this is a setup or anything, but that's typically how it would work. So that's all it is. Just a fair value gap that got closed through on the other side. And that means that would make that an inversion. Inversion fair value gap. Okay? Moving on. Next one is going to be market structure shift. Okay. And these are all elements to a trade. All of these are elements to a trade, how you put them together. I show you all my other videos how I put them together, but these are all elements that I need for a trade. So market structure shift is a change in the direction of price. And let's go and show an example of that. Okay. Now, first of all, you got to know how price moves. How does price move? Well, just like this. Okay. Price moves. Does price ever just go straight up and never pull back or anything? No. Never does. Price moves just like this. See how price goes up, do a little pullback, up, pullback. Right? That's how price moves. Very simple. Now, market structure shift is whenever the structure, basically you're looking at this move up like a leg. This is a leg going up. A shift is whenever it comes back down the other way. And how do you identify a shift? Well, each time you make a swing low, meaning the low of a candle, the lowest point is a swing low would be the candle on the right and the candle on the left are both higher than this one. So a swing takes 3 candles. And basically, a swing is when each one to the left and each one to the right is, if this is going up, is higher. So you see how this wick right there is higher than this one in the middle. And of course, this one up here is higher than this one. So that means this would be a swing low. See, 1, 2, 3, that's the lowest point. That's a swing low. Also, if you look right here, this one's higher. This one's higher. So the one that in the middle is the lowest point. That's a swing low. Now, a market structure shift is whenever the market takes out one of these swing lows. Okay, so a market structure shift would look like this. Price is going up, pull back. Up, pull back. Up, pull back. Now let's say it goes up, and you see this we're saying this is a swing low. Each one of these are swing lows, right? Now, a market structure shift would be whenever it takes out. It goes lower than the swing low. Now you have a shift, because what should happen is it pull back up, go down, up, down, up, down. So at this point would be the market structure shift. And that's essentially all it is. The end of a trend, you could say. When the trend ends and the market shifts the other way, that's a market structure shift. All right, pretty simple. Let's go find an example. Price going up. Oh, here you go. Okay, so you see this pullback right here. This pullback here, you have a swing there. You can say, technically, it's shifted here. But this is just a small pullback, higher high, and then here came down and it pulled back nicer here. But then look what happens is it made higher highs again. And then pull back here, pull back here, pull back here, and this is where the true shift happened. So if I erase this is the highest point. Pull back here, pull back, and you see how it could not make this high right here, could not make a higher high than that. And then after that, it pulled back and went underneath this low, this swing low. So a couple of keys here. This high and this one could not take out that one, right? So this high could not go higher. And then from there, it went lower than this swing low. So there's your market structure shift. And as you can see, when it pulled back up, again, lower, lower, and then continue down. So there's your shift, market structure shift. Just like that. That's all that is. Okay. Market structure shift. Now let's go to the next one. Next, we have sell side liquidity. Okay. How do you spot sell side liquidity? What is it? It's basically can be relative equal lows or a swing low. It can be previous day low, PDL, previous day low, which is if you take the entire day from the day before, the very highest point and the very lowest point, that is previous day low, or a previous session. So if I trade the New York Open at 9:30 a.m. Eastern time in the morning, the session before that is the London session. So if there's a London low, the lowest point of that London session, if price never took that out, there may be some sell side liquidity there. So at each one of these points, you're going to look at sell side liquidity. Okay. You'll hear me refer to sell side liquidity a lot. Let's go to the 15-minute chart because that's where I basically see all my liquidity for the most part. Okay. So here you go. If you look here, you have relative equal lows back here. Okay. So if I'm looking at price and I see price came all the way down this low right here and it didn't go lower than this one, but they're pretty close. Pretty close. Okay. And then you have this low. So this right here is telling me there's a lot of sell side liquidity, a lot of lows because these lows are slightly higher than each one. So it tells me price came down here, came down right there, went all the way up here, came back down just above it. Now, if price comes just below it, that means it took that liquidity. Because like, for example, let's just say that there was some sell side liquidity here. Price came up and it went below this. So that's gone. You no longer care about this. You just care about this low. And then you would see how price came here, and then it came back up, and then it got very close here, but not quite as low, which tells me there's some sell side liquidity here. And then if price opens or comes down, it's going to need to take that liquidity there. Okay? So that's what you'll see for sell side. Now, the same thing happens if you have the previous session or the previous day low. You might have, let's say, for example, this is the London low. Well, that would be some sell side liquidity there. Or if this was the previous day low, well, then you'd have sell side liquidity there. And you're looking for price to want to draw down to it and take that liquidity. Okay? So that's what sell side liquidity is. Now we're going to jump on to the next one, which is buy side liquidity. Basically the same thing, just on the upper side of the market. That's all. That's literally all it is. So if we go back to the chart here, and let's look at this like this. So if I'm looking here, I can look and say, man, there's a lot of buy side liquidity, because I would look at these right here. These relative equal highs are right here. And if you can see, it's vice versa. So you have a high here. Price came back up here, could not go higher. Came back here, could not go higher. But they're really close to each other. So that's going to be some buy side liquidity. Price is going to be, it's going to be like a magnet for price. It's going to need to go through there at some point. Same thing up here. I can look and say, wow, this high right here and this high right here, relative equal highs. We got some buy side liquidity there. Price is going to eventually want to come back up through there. It's the same exact thing as the sell side, except it's on the upper part of the chart. Buy side. Okay? That's literally all that is. Now let's move on again. Next one, we have a draw on liquidity. That's a draw on liquidity means that is where price is likely to go, where price is going to be drawn to. So you can say, and this could be different things, right? It can be a draw on liquidity would just be price running to that liquidity area. So if I saw this and said, that's a buy side liquidity right there. And then if price sprints there like it did here and takes this out and goes higher than that, that's a draw on liquidity. It drew to that liquidity. That's literally all that is. Draw on liquidity. Same thing, you can also say it doesn't have to just be those highs. Liquidity can also come in the form of, like, say, this fair value gap right here. See how price came right up to it? That can be internal range liquidity. So internal range liquidity is going to be when it's inside the range. So for example, if we have, let's just say we had this area, these highs, and then this low. And then you can see price came back up, created this, and came back down. So this I mentioned was relative equal highs. This is some buy side liquidity, but it's kind of inside this entire range. You see that? Since it's inside this entire range, this is what's going to be called internal range liquidity, IRL, right here. So price, it doesn't have to come all the way up here or even all the way up here. It could just come up to here and take this internal range liquidity before continuing down to some more sell side. Okay? So that's what that is. Draw on liquidity. Moving on. We have displacement. Displacement is when you have an obvious move with speed. Okay? Like, prime example right here. It's when price displaces out of the area. When you have price doing this, see how it's kind of just going here, kind of going here, here, here. Comes down here, but then here, 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 here. And then look at this. Boom, shoots down. This is displacement. Okay? Where else do you see on this chart right now that's obvious displacement? Yep, right there, where it's shot down. That's obvious displacement. And there's times where, like, let's say I'm trading and I see an area I think price can go to. And it's going. I'm like, okay, there's no reason. There's a lot of times I do this. There's no reason I think price is going to go down. So I'm not looking for a short to go down. I'm looking for price to come up to this level. Sometimes it'll go hit that level before I even get in a trade. I'm like, well, crap. Now I'm not going to do anything if it just keeps going unless if I see some obvious displacement. And when I say that, that's whenever something like this happens. Something like this happens. If I see that, then I'm like, okay, I might take a short now because that's obvious displacement. Now, this is the 15-minute time frame. So, this wouldn't have been traded. You can see right there, 15-minute. This wouldn't have been traded. But inside this displacement on the lower time frames, I could have probably gotten me a trade to go short because that's obvious displacement here. Okay. Now, let's move on to the next one. We only have a few more here to go because, like I said, I didn't want to get too deep into stuff. But next, we have an order block. That's an institutional move to deliver price somewhere. And what I mean by that, and I'm keeping it simple here, simple terms, y'all. Okay? So if institutions, basically, or anybody looking to move price, they're not going to just move price like if they're trying to go long and they're trying to trade hundreds or thousands of contracts, they're not going to just long that many contracts, right? They have to move in forms of liquidity. So an order block is basically a move in the opposite direction. So you see how this black bar right here, you see how it's a larger bar pushing down. And it went into actually this fair value gap right here. So an order block is typically going to move down if it's bullish. A bullish order block is typically going to move down into some form of liquidity, which means it'll go into either a fair value gap or take some, sell side liquidity. And after it does that, immediately price should go up and overtake that entire candle. And if that happens, this would be a good order block. So you can see that here. You can see we have a fair value gap right here. Okay. It didn't trade down into or below any sell side, any lows, but it traded pretty hard into this fair value gap. And immediately that closed and the next bar ran all the way up above it. Okay. So what that does is after that, you can take the open of the candle, which would be right here, and mark that out into the future. And price should, if it comes back into it, it should respect that. If it's bullish, it should respect that as support. If it's bearish, it should respect it as resistance and not go back above it. As you can see here, look what happened. If I take and mark the opening, draw it out, look at that. Perfect. Came right here. Now you're at that order block. If price is going to remain bullish, then it should go back up. And as you can see, that's what it did. So there's a lot of times where I get a trade on my lower time frame where I have a fair value gap and there's also an order block. And a lot of times when I see the combination of the two, yep, I'm probably going to take a trade in that direction. All right, so that's an order block. Next up, we have a volume imbalance. Okay, now that's the gap between two bodies of a candle. Don't get it confused with a fair value gap. Volume imbalance is two bodies of a candle. So let's find us a nice example here. All right, let's see. And typically, those are going to be better seen on the lower time frames. So let's go ahead and let's go to this 1 minute chart here. And here we go. They're not always as easy to spot. Okay, because they're sometimes small. But look here. You see the gap between the two bodies? So they take two candles. Okay, so we're going to look at these two candles. Okay, candle 1, candle 2. And look at the bodies. You see the bodies? You got a gap. You got the body here and the body here. And typically when you have that's a volume imbalance, okay? And when you have this, typically price doesn't go too far away from it without wanting to come back and at least wick through and fill that. That's usually what happens with these. Now, I don't particularly use volume imbalances for trade entries. If I have one, cool, then that's kind of like an extra confirmation. But I do like them more for targets. But if I draw this one out, look at this. Price came up, and it came all the way back down and wicked through it right here. And then came back up. So they're not the strongest thing, but if you have one as a target, or if you have one with your trade as a confirmation, you can see there's another one here. Price went up into it, kind of pulled back. So that's what a volume balance is. The gap between two bodies. All right. Next on our list, we have a dealing range. Okay. A dealing range is basically a high and low of a range, which is going to have typically external liquidity on the top and the bottom of it. And then when you take that range, the high and the low, you're going to split it in half. You're going to have a midpoint. The upper half is going to be a premium of that dealing range, and the lower half is going to be the discount of that range. Okay, so let's go to here and show an example. Let's find an example. And, you can measure dealing range in a bunch of different ways. But let's just say, for example, let's take this right here. Okay. We have this is the lowest point right here on this chart, and this is the highest point right here. So I can use that as a dealing range. And you can, have a lot of different ways you can mark dealing ranges. It can just be, you can mark a dealing range as this leg right here. If I'm looking at this leg going down, right? Then I can mark the high and the low and see what the midpoint is in the dealing range. Or if I'm looking at the 15-minute chart here, then I take the lowest point I could see, and then I could take the highest point I could see, and I'll mark the low, and I'll mark the high, and then that'll be my dealing range. And then wherever I see the midpoint, then the highs and equal highs and equal lows inside of this range would be internal range liquidity, like I mentioned. So here, if you have a low, relative equal lows, right? So this would be internal range liquidity. Remember I mentioned that right here, internal range liquidity. So if price is all the way up here and I'm like looking for a short and I get in a short, where could I target? I would be very confident in this scenario that price would come down here into this internal range liquidity. From there, do I believe it needs to come all the way down to the low? No, I'm pretty sure it goes there, but it could go there and then continue up, or it could go here and continue down. Not sure at that moment, but that gives you a starting point. So what I can do is, like I said, I can measure, get a fib, go the high, the low, and all you want to do is just put it in 4 quadrants, right? So that way you have a upper 75%. Right here's the midpoint, the lower 25%, and then the low. And now what this is called, the midpoint is called equilibrium. So from this midpoint here up is a premium. From this midpoint down is a discount. So if you follow the 2022 model, you can say, all right, I'm looking for a trade. If this is going to be my good dealing range here, right, then I'm looking to take a short down to either equilibrium or the first imbalance or sell side liquidity or internal range liquidity inside this, which would be here, internal range liquidity. I'd be looking, and look where it lines up with that. I mean, that purple line, this line right here, that's that midpoint of the fib. And that's equilibrium. And you can see it right here, right there. You just take a trade down to that. So you'd be basically going from a premium, selling at a premium, and taking it to the discount and get out. So let's kind of scroll over here. See what happens. If it ever comes back, it stays above, and then there you go. Comes right back into it. Took that internal range liquidity, and then made its way back up. So that's how you look at the dealing range. That's a dealing range. Premium, discount, and equilibrium. All right, we're almost done here. I think we have like two more to go, two or three. And next one here is going to be the opening range gap. Okay, this is the gap between the close of the previous afternoon session and the New York session open. Okay, how you look at that, well, on TradingView, you got to go to regular trading hours. And when you go to regular trading hours, basically it's going to cut out the overnight sessions, Asian session, and all that. It's going to stop the afternoon before when the New York Stock Exchange closes. See right here at 1600. It's going to stop there. And then it's going to cut out everything else until the open. If I go to this open right here, you see at 9:30 a.m. The times are down here on the bottom. So it's 1600 to 9:30 a.m. And the gap between that, that's going to be your opening range gap. That's all that is. Now, the rule of thumb is when you do have an opening range gap that is around 120 points or less from the close here, the afternoon before, and the open of the morning, the next morning. So I would take my open here, I could put my close there, and I already have this preset right here, opening range gap. And you could see, is it more than about 120 points here? Hold on, let me turn this off. My new day opening gap. Is it more than about 120 points? If it is, then a lot of times what you'd be anticipating is to see if price, you wouldn't really expect price to come down all the way through the gap. Maybe it'll go to the midpoint of it, or you can add an upper quadrant, just like I did with the fib earlier, where you have 4 quadrants basically. Right here, upper 75%. So you'd be looking to see if maybe it comes to this or the midpoint, but it's unlikely to come all the way down through it if it's more than 120 points. However, if it's around 120 points or less, that gap, then there's typically a 75% chance it comes down and closes that gap before 10 a.m. So that's what that is, the opening range gap. That's it. And then you just mark it, go back to your electronic trading hours, and that's it. Then you see where that gap is. Okay. Let me remove that. All right, so that's the opening range gap. Next, we have the new day opening gap. Okay, new day opening gap is similar, but the time, okay, is the gap between the close of the previous futures session and the open. Remember, the futures sessions close for 1 hour each evening, okay? So what you do is you don't change the the trading hours or anything like that. All you do is you're going to go to, so for example, this is Friday. And I usually like to do this on the 15-minute chart. This is Friday. Then you just scroll back here to the time, and you look at the time on the bottom right there, 16:45. That's the last bar because it's a 15-minute chart. Last bar before the market, the futures session closed. And then when it opens, it opens at 1800. So it closes for 1 hour every day if you're not aware. So that 1 hour, you want to measure the same thing, right? You'll come right here. You'll check out the close. You want to measure the gap, the distance between the close and the open. In this case, they're basically right there. There's no gap, okay? So I wouldn't even mark this one. So let's go back another day and let's see if there's one to mark. Okay, here's the previous day, 1800 and 1645. See, it closed there and opened there. Basically the same price. So there's no new day opening gap there. Let's go back another day. All right, here you go. Here's one. 1645, 1800. So basically what I'm going to do is I'm going to measure out the open right there, the close right there, and I have a preset NDOG, new day opening gap. And there you go. Typically, if it's more than like 20, 40 points, then you want to have a midline. If not, you don't really need it. But yeah, let's just see how, and what these are good for is they very well, a lot of times can act like a magnet, where if price goes away from it, it can draw price back to it or bounce off of it. And if you have a lot of them in a close vicinity together, then it acts like a stronger magnet. See, look, right here. and just kind of keeps staying around it. So that's what that is. Okay, the new day opening gap. All right. Next we have new week opening gap. Basically the same thing, and this is the last one, y'all, but basically the same thing as the new day opening gap, except for the new week opening gap is literally just from the Friday session close to Sunday night open, okay? So it only happens once a week. All right, so now we should have one now because it is Sunday evening. So right here, you have Friday, 1645, if you look on the bottom, and then you have Sunday night, 1800, okay? And it's just the gap between the two. So you mark the close of Friday, then you mark the open of Sunday, mark that new week opening gap. Okay, there you go. And if it's more than about 20 to 40 points, then I like to have that midline. And that's it. There's your new week opening gap. And you typically want to leave these for around 5 weeks. It'll continue to respect them. The new day opening gaps usually will respect them for a while, but you typically want to have them on your chart for at least 5 days. A rolling 5 days. All right, so that's it. That's my basic ICT terminology. The things that I use when you see my videos and you hear me refer to some of these names, acronyms, words, that's what I'm talking about. You can always come back to this video and see the definitions and what things mean. So for now, that's all I have on this one. I hope you picked something up. I hope you learned a few of these definitions, terminologies. If you didn't know how they worked, a little bit how they work, keep watching my trade recaps and watch my framework video, and you'll be able to see how I put it all together. All right, so that's all for today. As always, I hope you have a good one and trade well, everybody.